Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you need sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. For those of you that listen to the Loonie Hour podcast, appreciate you. Those who came out to the live event in Vancouver, we had nearly 200 people, sold out event, paid for tickets. People coming from all over Canada, Ontario, Alberta, and here in BC. Really appreciate your support. It's amazing to see what we've done just 31 episodes in as we continue to grow the Loonie Hour community, in addition to these weekly Saturday videos on the Saretsky show. So I want to get into this week's show. We talked about it last week, which was the impact of the stock market falling and how that's going to impact the housing market, because these are all a relative game. All these markets are interconnected. And one of the big things that I think people need to start to appreciate is the down payment, the source of down payments for home purchasers, particularly in these leveraged markets like Vancouver and Toronto, because people always ask me, "Oh, Steve, where's the money coming from? How are people buying these? The benchmark house price in Vancouver for detached houses over $2 million. Where are people coming up with a $500,000 down payment?" Well, I mean, I can tell you that people aren't, working a 9 to 5 and saving for 15 years. That's just not how it happens. What we're seeing is that people are leveraging existing assets. So you've either made money in the stock market, the crypto market, or you've already been on the housing ladder for the last 8 years and you've built in a whole bunch of equity. And so you're able to leverage that up into, say, from a condo to a detached house, you're able to add a second property, etc. So a lot of it is like the rich kind of get richer. People that have assets are participating in the market, and those that don't are not participating in the market. And so that's why I look at it and say, when we see the stock market down, that is going to have an impact. And, we saw the implosion this week in the crypto market. I mean, for example, one of the largest cryptocurrencies, Luna, which to be honest, I actually had a very, very small portfolio of Luna. One of the most hyped projects out there, backed by billionaire Mike Novogratz with Galaxy Digital. He literally runs a publicly traded crypto firm. We had Delphi Research, which is probably one of the most respected research firms in the space, was also promoting the Luna ecosystem. And that cryptocurrency literally went to zero in a matter of like 7 days. And so that's just wealth that is instantly removed from the market in its entirety. And if we actually look year to date, global wealth has been evaporated. So $35 trillion year to date has been removed from financial markets through the decline in asset prices. So when we see big tech selling off, if we see Shopify down and PayPal down 70+%, that's going to impact people. Some of that's in their portfolios. You have some that are employees at these companies that are all of a sudden, hey, your stock options at this company suddenly aren't worth that much. You're compensated. It's almost like a reduction in compensation for a lot of people. So, I can tell you firsthand, working in the Vancouver housing market on a day-to-day basis, I've had several clients this year that have used crypto gains as a source of down payment. Some of these people have been long crypto for the last 2 years, have made insane amount of money, and they've opted to liquidate, portions of their portfolio to go and buy real estate, a hard asset. And so again, if we look at and say, well, Bitcoin and Ethereum and some of these bigger asset classes are down 50+%, suddenly buyer demand starts to wane. Suddenly there's just less demand for housing, and you tack that on with the increase in mortgage rates, and we can start to figure out why, Vancouver housing sales were down 34% year over year in April. And, in the greater Toronto area, seasonally adjusted sales were off 26% month over month. So things are changing significantly. We've also talked about in the past on how the impact in Canada, it's a highly levered housing market, particularly in sort of the Vancouver, Toronto, the two largest markets. When we start to see alt lending rates, this is a very fast pace of mortgage tightening that we're seeing. So you have, for example, Home Capital and Equitable Group. Typically speaking, these are lending to entrepreneurs and business owners. These are usually on 1 to 2 year terms. We're already seeing their mortgage rates up 200+ basis points. So that, again, is going to result in this tightening in financial conditions. And this really gets to the crux of it because, as I chatted with Professor Steve Keen, you have to understand, how money is ultimately created, and particularly so in Canada. 90+% of new money that is created in the system, new credit, it's created through commercial banks issuing new loans. And the bulk of those loans in Canada are created through residential mortgage lending. In fact, if you look at it in over the past 2 years, so Canadian mortgage debt grew at an average annual of $150 billion a year in 2020 and 2021. $150 billion per year in new mortgage credit issuance. That's double the annual growth rate between 2015 and 2019. Now, again, these were not slow years. 2015 to 2019 was arguably a bull market for the vast majority of that time. And so you've had mortgage credit growth running at double that over the past 2 years. Residential mortgage credit growth currently running at 14%, which is the highest since 2010, I believe. So it's no surprise that every mortgage broker and every realtor has had probably the 2 most successful years of their career during the pandemic, because a whole bunch of gobs of money was created and falling from the sky. And so now we have the situation where central bankers are trying to rein in all of this credit. And we're kind of walking this fine line, because basically, as we talked about with Professor Steve Keen, is a lot of this inflation is supply related. It has to do with global supply chains. It has to do with manufacturing. We're re-onshoring that back here. That inflation is probably going to stay sticky. So the only thing that central banks can do, right? They can't pump more oil. They can't grow more grain or more wheat. All they can do is take demand out back and shoot it in the back of the head. And so that's basically seems to be the plan, is let's just keep hiking rates until something breaks, and let's kill demand. And so that's exactly what they're doing. Like I said, evaporated $35 trillion year to date. And if you're thinking about the knock-on effects of that, people just feel less wealthy. Again, when your stock portfolio goes down, it just gives you less ammunition to then go and buy another rental property, for example. So that's something to sort of keep in mind. But then we have basically the knock-on effects of that I'll be watching here moving forward, because we're already starting to see some developers slowly start to wind back projects and saying, you know what, maybe we don't launch the project this year, maybe we wait. And part of that has to do with, again, really the most important metric, the cost of money, financing. So if we look at, for example, I'll give you one example here with the CMHC lender. They were locking in construction loans about 4 weeks ago at 3.5%. So 3.5%. Today they're running now at 4.5%. So just that increase in the cost of construction is going to end up requiring an extra couple $1 million of equity to put into the deal, right? If your cost of financing is up, if you're taking on a whole bunch of leverage to build the project, and the cost of interest goes up, you then have to put more equity into the deal. So a lot of these developers are saying, well, hold on a minute, now I got to come up with an extra $1 million, $2 million, $3 million to build, this rental apartment building. All of a sudden the numbers no longer make sense. So it's not only going to erode and evaporate that, but if you're a developer in, let's say, Vancouver, so typically speaking, in order to get construction financing to actually construct the building and get it closed and completed, you typically have to pre-sell 60% of the units that come to market. So the banks are typically saying to the developer, listen, we'll give you, $20 million to build the condo building, but in order for us to give you that $20 million, we want to see that you've sold 60 to 65% of the building. And so developer now has, under the Real Estate Development Marketing Act, they have 12 months to sell. They have, I believe it's 9 or 12 months to sell 60 to 65% of the units. So you're in a situation now where the developer has to make a decision. Okay, well, do I launch the building and do I really confidently feel that I can sell 60 to 65% of the units in a 9 to 12 month period? And if I can't, then I've just spent all this time, this effort, this marketing cost, the advertising dollars, spending money on sales staff, only to come up short, only sell 45% of the building, and now I can't get construction financing. So you see, it's kind of like this double-edged sword, is that's part of the reason why, developers throttle supply in a down market, because a lot of it comes down to, it's not so much always the developer's decision, but it's actually the bank's decision. The banks say, listen, you ain't building because we're not giving you any money. And so that's kind of creates this sort of knock-on impact. And obviously we know in Canada, the role of real estate and real estate construction, I mean, all you have to do is look at the employment sector in Canada. It employs directly 7% of the labor market is in construction. So as you start to see projects being paused, or you know what, instead of launching this year, let's sit on it for another year or two and just see how the market sort of shapes up here, because there's a lot of uncertainty. And as I mentioned to some of you guys in the podcast in the Loonie Hour there, you know, I've had conversations with some of the largest construction financing companies in Canada saying, listen, we're not inking any deals right now. The pen's down. We don't, like, I don't, unless the deal is an absolute slam dunk home run, no deals are getting signed right now. So it's going to be more and more challenging for developers to get construction financing, and these are going to have these knock-on effects of the economy. So central banks, especially when you have this levered of an economy, have a real ability to kill demand, and they can kill it quite easily. And that really is the central bankers' solution for inflation. They cannot fix the supply chains. They cannot fix what's happening in the oil market. But what they can do is kill demand, erode wealth, and hope that reverse wealth effect comes into play. I mean, I think it's pretty safe to say that, you know, if your house goes down by 20%, your stock portfolio gets cut by 30%, you're probably inclined to spend a little bit less money. And so that's kind of the idea about slowing the pace of demand and easing inflation. So anyways, I hope that kind of makes sense. If that's the things that I'm watching here in the housing market, is really just the knock-on effects, right? Like, we aren't necessarily we're seeing some price corrections in the housing market, but all you kind of have to do is watch at what's happening in other parts of the market, stock market, crypto market, to get some leading indicator as to how is that going to impact demand moving forward. And again, you know, it's interesting because people are asking me and saying, well, you know, where's the most vulnerability? Mortgage rates are going from 2.5% to 4%. You know, is it that, wow, these $5 million houses, these guys are really going to feel it, eh? And I go, no. People that are buying $5 million houses aren't typically borrowing a lot of money. You know, they don't care if the rate goes from 2.5% to 4%. Okay. The people that feel that are those entry levels, the blue collar workers, are just stretching themselves just to get into the housing market. They're scrapping together all their money, all their life savings, and all of a sudden the mortgage rate goes from 2.5% to 4%. Your mortgage payment increases by $800 a month. That's who it impacts. Those people become stretched. The people that are buying $5 million houses, though, are relying on the stock market, or there are on various gains in different asset classes. You know, the wealthy own assets. They trade assets for assets. And so if their stock portfolios get whacked, you'll probably see that demand start to fall off as well there. So keep in mind, this is kind of how it works. That's why I'm saying I still think that the most vulnerable markets are going to be in the suburbs, where valuations were extremely stretched. People were taking on a lot of cheap leverage to sort of get into the market, sort of keeping up with the Joneses mentality. And as those payments start to increase, not only that, but as their fuel prices start to, continue to increase, as their food prices go up, and as their wages, at least on a real basis, fail to keep up with the cost of living, it is ultimately basically inflation is essentially like an additional tax. So that's kind of how I'm looking at it. We're going to get some national housing data here on the 15th of May. I'm expecting national home sales to come in, down 25 to 30% on a year-over-year basis. And the media is going to run with those headlines. So keep an eye on that. But as always, we'll see you next week.